Welcome to a comprehensive exploration of cryptocurrency regulation, where chaos meets clarity, fear confronts opportunity, and regulation shapes the future of digital assets. This presentation will guide investors, policymakers, and crypto enthusiasts through the complex global regulatory landscape. We'll examine the historical evolution of crypto regulations, analyze the current fragmented global approaches, dissect the US regulatory framework, and forecast future regulatory developments, all while highlighting both the challenges and opportunities in this rapidly evolving space. In the early days of Bitcoin, introduced by Satoshi Nakamoto in 2009, the cryptocurrency world was akin to the Wild West. It was a niche technology operating in a regulatory vacuum, attracting a variety of users. As law enforcement agencies began to notice, the first regulatory actions were taken, targeting notorious cases like Silk Road. This era also saw the rise of dark markets, leveraging Bitcoin's pseudonymous nature for illicit transactions, which highlighted the urgent need for regulatory frameworks. The initial coin offering, ECO, boom from 2016 to 2018 was a period of explosive growth and subsequent bust in the crypto world. Projects raised billions, but many failed, leading to significant investor losses. This period saw rampant scams and fraudulent projects, prompting regulatory bodies to take notice. China's ECO ban in 2017 marked a turning point, emphasizing the need for clearer frameworks to protect investors while preserving innovation. The post-ECO bubble burst from 2018 to 2020 led to a significant market crash, with Bitcoin losing over 80% of its value. This period of pain forced regulators to begin distinguishing between cryptocurrencies, securities, and utility tokens. The lack of coordination between agencies highlighted the need for a more unified approach to regulation, as the market matured and investor losses mounted. From 2020 to 2022, the COVID-19 pandemic accelerated cryptocurrency adoption, with institutional players entering the market. This mainstream acceptance brought heightened regulatory scrutiny, as authorities sought to integrate crypto into existing financial systems. The launch of Bitcoin ETFs and increased focus on stablecoin security were significant milestones during this period, reflecting the growing importance of regulatory oversight. The collapse of FTX in November 2022 was a pivotal moment for the crypto industry, revealing massive fraud and misappropriation of customer funds. This event served as a painful but powerful catalyst, pushing regulators to accelerate comprehensive frameworks. The industry itself began advocating for clearer rules, recognizing that a structured approach could foster sustainable growth and protect investors. Globally, countries have taken varied approaches to cryptocurrency regulation. Some, like El Salvador, have fully embraced crypto, while others, like China, have implemented outright bans. Many developed economies have adopted strict control measures, balancing innovation with consumer protection. This patchwork of regulations highlights the challenges of achieving a harmonized global approach to crypto regulation. The European Union's Markets in Crypto Assets (MiCA) regulation represents a significant step towards a harmonized regulatory framework for cryptocurrencies across Europe. Set to be implemented between 2024 and 2026, MiCA aims to provide legal certainty and protect investors while fostering innovation. However, challenges remain in ensuring consistent application across member states, particularly in the decentralized finance space. Asia presents a diverse range of strategies towards cryptocurrency regulation. China has taken a hard stance with bans, while Singapore adopts a progressive regulatory approach, and Japan leads in self-regulation. These varied strategies reflect the region's complex economic landscapes and highlight the balance between fostering innovation and ensuring financial stability. In the Middle East and Africa, countries are emerging as new frontiers for cryptocurrency innovation and experimentation. The UAE and Bahrain are leading with regulatory frameworks that encourage crypto exchanges, while African nations like El Salvador and the Central African Republic are experimenting with Bitcoin as legal tender. These efforts highlight the region's potential to leverage crypto for financial inclusion and economic growth. Latin America is experiencing a dynamic shift in its approach to cryptocurrency regulation. Brazil has implemented comprehensive crypto laws, while Argentina and Mexico face challenges due to inflation and currency controls. These countries are exploring innovative solutions to encourage financial exchanges and protect investors, showcasing the region's potential for growth amidst regulatory challenges. International bodies are working towards harmonizing cryptocurrency regulations across borders. Organizations like the FATF, FSB, and the World Economic Forum are establishing standards and frameworks to address the challenges of cross-border transactions and regulatory compliance. These efforts aim to balance national sovereignty with the need for a cohesive global regulatory approach. Central bank digital currencies, CBDCs, are emerging as the state's answer to private cryptocurrencies. Countries like China and Nigeria are leading the way with digital currency initiatives, while the European Central Bank is exploring a digital euro. CBDCs offer the potential for greater financial inclusion and stability, but also raise questions about privacy and state control. Key global regulatory trends in cryptocurrency include a focus on consumer protection, AML, CFT compliance, and stablecoin regulation. As the market evolves, regulators are grappling with how to approach decentralized finance and ensure market integrity. These trends highlight the ongoing challenges and opportunities in creating a stable and secure crypto ecosystem. Global crypto regulators face numerous challenges, including the pace of innovation, jurisdictional differences, and asset classification issues. Balancing innovation with consumer protection and addressing regulatory arbitrage are critical to achieving a cohesive regulatory framework. These challenges underscore the complexity of regulating a rapidly evolving industry. The United States has a complex and fragmented regulatory framework for cryptocurrencies, with multiple agencies involved. The SEC, CFTC, and IRS each have their own approaches, creating a challenging environment for businesses and investors. This overview highlights the need for a more coordinated approach to regulation, as the industry continues to grow and evolve. The SEC plays a crucial role in cryptocurrency regulation, applying the Howey test to determine if cryptocurrencies are securities. The agency has taken enforcement actions against major exchanges and is increasing oversight of crypto trading platforms. This approach has created tension between the industry and regulators, highlighting the need for clear and consistent guidelines. The CFTC regulates cryptocurrencies as commodities, focusing on market oversight and enforcement actions. The agency's approach creates a jurisdictional overlap with the SEC, leading to challenges in establishing a clear regulatory framework. Legislative proposals aim to address these issues, but the ongoing tension between the two agencies continues to impact the industry. FinCEN is responsible for ensuring AML, CFT compliance in the cryptocurrency industry. The agency requires businesses to register as money services businesses and implement customer due diligence programs. FinCEN's regulations aim to prevent illicit activities and protect consumers, but also present challenges for businesses navigating the complex regulatory landscape. The IRS treats cryptocurrencies as property for tax purposes, requiring investors to report gains and losses. This approach has increased compliance efforts and created challenges for crypto users. The IRS's focus on taxation highlights the need for clear guidelines and solutions to address the complexities of crypto transactions.